Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone, and thank you for tuning in to another episode of No More, Risk Better. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy at CreditSights, and today I'm delighted to be joined by my colleague, Andy DeVries. He is, of course, our head of investment grade research and head of utilities. Andy, thank you so much for coming back on the podcast.
Great to be here. Thanks, Zach.
All right, so last time we chatted, we were going through your out of consensus call that utilities are going to overbuild in this era of data center demand. Now we have another interesting call from you, Andy, that we want to go through for our listeners that does not seem to be sort of in the mainstream. There's been a ton of news, a ton of shifting environments within the global economy as the Iran war has broken out. We've seen energy prices come up. Prior to the war, we had oil around $65 a barrel. We're still up over $100 a barrel today. Gasoline has come up meaningfully. Natural gas is interestingly down. So maybe, Andy, to tee us up in terms of what you're seeing across the energy and power space, kind of take us through how we could be seeing lower natural gas prices with this big rise in energy broadly.
Sure. So obviously the firm's energy analyst is Charles Johnston, who sits next to me, but he's in Florida. He's got 15 101s lined up at an MLP conference. So I'll just sub in for him a little bit and say the reason that natural gas is down, and just to quantify that, the 12-month strip is down around 10 cents to around 350, is, you got about 15, 20 BCF a day of associated gas that's coming out with no price economics at all. It's just trash gas. It's coming out of oil wells. So as the producers drill for oil, this gas is just, has no cost at all. So with the expectations on oil rising so much, and the 12-month oil strip's only up $20 to 85. Expectations are the producers will start ramping up the oil production, which then brings online more associated gas. So that's why natural gas is not rallying there. And obviously our export capacity is running all out anyway. So we're not able to flood the supplies there anymore.
All right, that's helpful to tee things up. And from a macro perspective, which is where I live and breathe, obviously we've seen a huge increase in treasury yields and government bond yields across the curve, and that's really been in focus. One thing that hasn't been in focus is the idea of clean energy tax credits coming back. That's, I'd say, one of your latest views, something that you've been taking out to clients that hasn't been something on their mind. So kind of take us through the logic there and maybe whether or not you think it's appropriately in the market narrative today.
It's shocking to me. It's absolutely shocking to me. I've been doing this for way too long. These tax credits always come back. Always, always, always come back. Obama, very pro clean energy guy, tried to sunset them and they came back. So anyway, we think they come back. 4 real drivers here. The first one is energy prices, as you mentioned. It's mainly on the gasoline side that gets the most, political attention here. $4.50 a gallon. We're at $3 before the war broke out. That is a monster increase. So that's the first driver. The second is the Democrats are going to take the House. 80% chance of that happening of Holly Market. That's going to happen. And obviously, the Democrats are very pro clean energy. So those are known. Everyone talks about them. Less known is the significant clean energy spending in the Republican states from Biden's Inflation Reduction Act. So depending how you slice and dice it, numbers are all over the place. Over 2/3 of the spending was in Republican states. So you think about the Carolinas, down into Georgia, even upstate New York, and you're talking about solar panel manufacturing facilities, solar module manufacturing facilities, battery facilities, significant investments in red states. So, you get an issue like raising taxes, that's something the Republicans will just, the hill will die on. They're not going to do it. Clean energy is something I think the Republicans will do it. And so if you look when Trump killed the EV tax credit 90 days after one big beautiful bill, I think he got so much pushback in his party that you couldn't do the same thing to win in solar because of all that. So that's the third pillar there. So energy prices, Democrats take the House. The third is the Republicans, clean energy investments in Republican states. And lastly, think back to Biden's Inflation Reduction Act. 2022, data centers, no one was really talking about this stuff. ChatGPT didn't get released until the end of that year. So this was like game over. This was just religious for the fossil fuel lobby. Like this could be good night for their natural gas demand. Since then, we've got data center demand. And you've got the war in Iran. So I don't think you're going to get this huge pushback from the fossil lobby, who's obviously very strong in the Trump administration. So I don't think you're going to get that pushback now if they were to bring back some of these tax credits. So those are the drivers there, Zach. Energy prices, Democrats take the House, significant spending in Republican states, less pushback from the fossil fuel lobby.
Well, that all makes very clear sense to me. And to just zoom out for a second, I know you alluded to this quickly. So what exactly did the One Big Beautiful Bill Act do to the clean energy tax credits? And if it's helpful, even framing up some of the provisions of the Inflation Reduction Act to just help some of our listeners that may be less familiar frame kind of the environment pre-Trump 2.0, where we are today, and sort of where that sets up to take us going forward.
Sure, I'll start with the tax credits and then go to what Trump did to them. So, we like to joke around. These tax credits were not like the icing on the cake, like, oh, I might go solar. Oh, yeah, this will put me over the edge. Like, these are the flour and eggs in the cake here. So, in a forward power market that's $60, give or take a megawatt hour, this gives you a production tax credit of $26 a megawatt hour for 10 years. So, you can take the production tax credit if you're a high capacity factor source of clean energy, like wind is. Or you could just get 30% of your money back on day one, which you use for a lower capacity factor clean energy like solar. Both of those then have 10% bonus adders. That's 10 percentage points bonus adders if you do it in a community that's been impacted by fossil fuels, various other bonus adders. So very, 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 very strong tax credits. And then what the One Big Beautiful Bill did is when Trump signed that last July 4th, it rescinded the and then electric vehicles. It was obviously $7,000 a vehicle, and then there was tax credits for hydrogen batteries. I won't go into all of them. I'm focused on the wind and solar because that's really what we're focused on here. So the One Big Beautiful Bill stripped the tax credits for EVs entirely after 90 days and for residential solar after 90 days. The wind and solar utility scale stuff, again, I think because there's so much investment in the Republican states, that was phased out over time. So as long as you came online in the next 12 months, you then didn't have to come online but until the end of 2027 or 28, depending on the tax credit. So those things really start sunsetting, whereas the others were just killed outright.
All right, so I think it's safe to say that expectations for wind and solar power production fell after the One Big Beautiful Bill passed.
Absolutely. So everyone on Wall Street has their own forecast for wind and solar. They're all centered around Bloomberg New Energy Finance. So looking at BNEF, the estimates for solar, this is from 2025 to 2030, went from 250 gigawatts of solar to 220 gigawatts. So that's not that much of a decline, but over wind fell from 150 gigawatts to 30 gigawatts. So just to state the obvious, wind runs at night when you don't really need the power, so it's even more reliant on tax credits. Solar, not so much because it runs during the day when you do use this stuff. Also, as data centers right now are training their models, that's 24/7. But if you look at these estimates going out to 2030, 2035, inference takes over and really gets up to about 90% of data center use. And inference use, I know we all have agents working in the background to do stuff, but the inference is really going to be when you're awake and when you're doing things. So again, that's solar more than wind.
And can you frame up those numbers in terms of, I don't know what the most helpful, and to be honest, I don't even remember which side is production or use when you talk about power, but some of these, 220 gigawatts falling from 150 to 30, what is total power usage annually in the US, or whatever the benchmark metric is, just to frame up the importance of this in the broader spectrum?
There's around good question. There's around 1,400 gigawatts of installed capacity. Peak usage in the hottest day in the summer in this country is around 850 gigawatts, and the average is closer to 600, throughout the year, going steady state. Data centers ended last year around 45 gigawatts of capacity. Numbers are all over the place. That was Goldman's latest number, so we'll run with that. And capacity factors on those are around 70% or 60, 70% for this. The more important figure here is, which no one likes to talk about, is we've retired 170 gigawatts of coal that used to run at around 50%. And now you're saying we're going to add around a similar amount of data centers that are going to run around 70%. And you're going to replace that with wind and solar. Wind only runs 35%, 37%, and solar 25%. So there's the mismatch. And that's why everyone's saying, you need more gas generation. So that's pretty consensus. Everyone talks about data center demand growth. What no one talks about is for the next 2 years, there's going to be more solar coming online than data center demand growth. So I'm not going to go too far off topic here, but you're going to add 60 gigawatts of solar this year running 25%. So that's 15 gigawatts running 24/7. Data centers, you're only adding 7, 8, 9 running 60, 70%. So that's a negative for power prices. Obviously, there's regional differences, there's hour differences, but that's a negative for power prices. You saw that, absolutely saw that in Texas in the first quarter where power prices just plunged. Even next year, 2027, solar is still going to be 50, 55, data centers maybe 9, 10, still net negative. 2028, it starts to shift. 2029, now Trump's killed your tax credits, although I think they come back. And then all of a sudden, data centers are adding 12, 13, 14 gigawatts, and solar has fallen off a cliff. And that's when the power prices really start rocketing. You're not seeing that in the forward curves for power, and that's where I think you can make a lot of money. You can make it on the natural gas side because those curves are flat as well. You can make it on the power side, or you can make it in the convertible bonds, the stocks of these names. It's limitless opportunities here.
So I definitely want to get into that, but before we do, assuming you're right and these tax credits are coming back, what is a realistic time frame and what path is there for that to happen legislatively?
Everything I've said before is ultra high confidence. As far as timing and the mechanisms, it drops to sort of a moderate level of confidence. So nothing's going to happen this Congress. We know this because the Democrats have to take their majority here. So I would assume that as midterms get closer, Hakeem Jeffries would be the shoe-in to be the Speaker of the House when the Democrats take over. So when they come back from their summer recess, eventually people will start talking, what are your pillars? What are your 3 objectives, 5 objectives? What are the hills you're going to really plant your flag on? And I think one of those will be clean energy. So I think you start talking about that in the fall when they come back from summer recess. And then as the midterms get closer and closer, it gets more and more traction. So fairly moderate view, that's what happens. And then when does Wall Street try and start front running that? We're not seeing in our trade pubs, we're not hearing our management teams, we're not hearing our client conversations the potential for these to come back. So that's why I do think there is still some room to run there. And also, it's worth pointing out real quick, Zach, some Republicans have already proposed legislation to bring back these exact tax credits that I was talking about earlier. So it was congressmen from Ohio, Pennsylvania, and New York that proposed the American Energy Dominance Act. But obviously, that's not going to go anywhere in this Congress, but maybe it's a sign of what's to come.
I think it's really interesting to consider the idea that the Democrats are incrementally going to take power in one form or another. It seems, betting markets make it pretty clear that they're expected to take the House, Senate, maybe a little bit more of a toss-up. But the point around red states set to benefit from a reintroduction of these clean energy tax credits makes for a uniquely interesting possibility of perhaps bipartisan legislation, which feels like a foreign concept these days. And when you think about, what's kind of going on right now, what's being batted around through the budget reconciliation process and ways to get around the need for a 60-vote majority in the Senate, do you have any sense on, kind of based on what is being thrown out there by some Republicans, as you just alluded to, what that could look like in the next Congress? That might be a little bit too detailed for kind of where things stand today.
I'm smart enough to know that I'm not going to speculate on the horse trading of Congress, especially the next Congress. But I think it's just one of these things. Like, it seems like Republicans are adamantly opposed to anything to do with tax increases. But when it comes to clean energy, I think they are willing to do some horse trading here and there. So it's, hey, instead of these things sunset after 28, we'll make it 2032. And as I said before, I've been doing this for way too long. These tax credits always are extended. So I've seen them be extended 6 times. Half of those were after they were supposed to sunset already. And so in my 25-year career of doing this, we've only gone a couple months without these tax credits being available. And I just don't see any change now. And then you layer in Iran and Iran's energy costs on it. To me, it seems like a no-brainer.
All right, so we'll leave the horse trading in Congress to Congress. Where we live is in the financial markets. So how do you play this trend, assuming you're right and they come back? I think you alluded to this a little bit, but take us through your favorite plays and how to position ahead of the market talking about it, because this is when you have the opportunity to make some money before it's out there in the broad market narrative.
So unfortunately, it's mainly on the equity side. So you're looking at things like the TAN ETF, TAN, and that's got a lot of the utility scale solar in there. It's got Next Tracker in there, which makes the tilts for the solar panels for utility scale. So you can tilt them when the sun goes down, so it increases your capacity factor. And then it's got residential solar in there, which lost their tax credits entirely, and if those come back. So that's really the best play in there. And then you've got some convertible bonds. These are the ones issued by names like Enphase, Array, and Sunrun. They're not busted by any means like they were back in 2022, but it does have some sort of asymmetric returns to them. I mean, they're in the money, so it's not exactly, you're going to make a fortune on them. It is an equity play, even though it's a bond. And then our sister company, LFI, they put out a whole list of every convertible bond that touches clean energy. Unfortunately, a lot of them gets into the EV makers, which I would not be touching those. But so you can really just go straight out equities on the solar names. You can go the TAN ETF for less risk, and then you can go to the convertible bonds for even less risk, but all have upside to these tax credits coming back. I will highlight the TAN ETF is a pretty high beta instrument. It's loosely correlated to the NASDAQ, but that would be the play there.
Why would it be correlated to the NASDAQ? I don't.
They're higher beta names. So you consider the S&P 500 if you consider the S&P 500 beta of 1, and then the NASDAQ's like 1.3 or whatever it is,
right.
The TAN moves with those NASDAQ names.
Interesting. All right. So is there a play in utilities?
All the utilities that own generation, which is around half the utilities, because the other half are wires only, they'll take advantage of the new tax credits, but that advantage flows to their ratepayers. Maybe you and me. Actually, more you, because Duke owns generation and Connecticut Light and Power does not. But it's really in the utility side, it's NextEra, their non-utility arm, that's the real beneficiary. And so both sides of their generation arm, it's the renewable side and the gas side, will just be going gangbusters, because renewables is already going gangbusters because you've got corporations that want solar and you've got big tech that wants solar. And then you've got such data center demand, which we talked about before, they actually need new gas. So NextEra will build you the gas. So that GenCo over here is growing upper teens, whereas Florida Power and Light, the utility, is growing high single digits. And the agencies keep them at a requirement of 70% regulated earnings. So simple math says you're going to blow through that 70%. You're going to fall under that 70%. And that's why they just went out and spent $65 billion acquiring Dominion, not because Dominion had any great assets for this play on data centers or this play in renewables, just because they had to keep their overall portion of utility earnings this high. It's really Near, which is the Genco arm of NextEra, that's going gangbusters. They're already going gangbusters from data centers. And if you get these tax credits, it just drives it even higher. So everyone's in love with NextEra, but that's really the pure play beneficiary, or the beneficiary in utility land.
Well, I'm glad that came up. Obviously, that's a huge deal, NextEra and Dominion tying up. Is there anything else on that deal that you want to mention to our listeners, maybe outside of the lens of this clean energy tax credit and some of the underlying drivers there?
We don't think it kicks off a trend. We really think they were forced into doing a regulated M&A deal. We do think the deal gets done. There's a lot of skepticism. It's still a 7% discount to the bid. I think merger arb funds have been blown in the past because NextEra has tried to acquire so many utilities and has never gone through. In this case, they need to do this deal. So I think they really sharpened their pencils before announcing it, and they gave $2.25 billion of tax credits to ratepayers in Virginia and North Carolina to get this deal done. So if Abigail Spanberger is running for office again and everyone's complaining about their power bill, if she doesn't let this deal go through, whoever's running against her could say, look, you had $2 billion sitting on the table for your ratepayers and you turned it down by denying this deal. Like, that's a pretty strong argument for a competitor. So I think she's going to have to let this deal go through. There's also lower barriers to getting a deal done in North Carolina and Virginia than other states. It only has to be in the public interest. There doesn't have to be a net consumer benefit. Even if there was, they've got the $2 billion. So we do think this deal goes through, and we like the arb trade there at the 7%.
All right, very helpful. Andy, we covered a lot. I think having your views, having this long run perspective covering the utility space is invaluable for our clients and in this case for our listeners. Is there anything we missed in terms of what's core to your call for clean energy tax credits coming back as they have, like you mentioned, 6 times in the past 25 or so years that you want to highlight to our listeners?
I don't think our core listeners are commodities traders, and there's no quicker way to go bankrupt than trading commodities. Looking at the forward curve for natural gas for 2027-28 stays at 370, and that actually drops 10 cents in 2029, 2030. That just seems very mispriced to me. On the data center alone, that demand is, at least 5, 6, 7 BCF. And then the LNG export side, you pick up another 10 BCF there. So unless oil prices stay up here at 100, there's no way. I think you've got to see that the natural gas curve steepen. So I think you put a steepener trade on the gas curve.
All right, steepener on natural gas unless oil prices stay above $100 per barrel, which admittedly you're starting to see the Treasury market contemplate pretty seriously, if I'm being honest.
Yeah, it's a tough one.
It's been an uncomfortable week or so having a 375 10-year Treasury yield target for year-end 26, Andy. And we're recording this on May 20th. I know we're going to flush that out a little bit more in our IG meeting in about an hour. But I think we'll wrap up there. Andy, thanks so much for coming back on No More Risk Better.
Thanks, Zach. Thanks for having me.
And thank you all for tuning in. If you enjoyed this episode, hit the like button, subscribe, comment. I don't think I've said that before, so I need to add that to my typical sign off. But thank you all for listening, and we'll catch you next time. Good luck out there.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.